guys have questions when we're going through them, we'll stop and answer them for sure.
Absolutely.
Open it up at the end for a Q&A.
Yeah, definitely encouraging the questions, and we can take a small pause as we go through to kind of address those, and like Jake said, kind of circle back at the end, and make sure that we have kind of an open forum.
It's the Sonny and Cher show.
Well, Mike and Jake, I'm so happy we're doing this.
First and foremost, just from all of us here, and obviously Jake and I, Keller Williams family, thank you for taking the time to come share this information with us and listen to what we have to say, hopefully ask some good questions. And all we hope is that you take the information, find something in this that is useful, and hopefully we can be here to help serve you in meeting your future goals. So that's what this is all about.
And whether you're a first-time home buyer or a new agent, I mean, knowledge is power, so knowing what we're getting into and directing our people in the right way and getting them on the right path is kind of the goal of this. So
that's exactly it. Yeah, I think that Jake and I both consider ourselves an advisor more than just a typical, mortgage lender, if you will. Although that's what we're here to do, lend money. There's so much more to it, and I think that throughout this meeting today, that you guys will hopefully kind of find some of it out. So.
And if it's your first time, require some hand-holding, and we're happy.
Absolutely.
That too.
Definitely.
So, I mean, there's 4 real pillars that we look at as far as mortgage financing goes. So you want to start credit?
Sure. Yeah. I mean, that's always the big pink elephant in the room for many is credit. And
there's a lot of misconceptions.
We'll go over all
it.
4 if we just briefly: credit, income, assets, and the favorite one, property, the house. So as far as credit is concerned, there are a lot of misconceptions that are out there in the world. And even now in our current, I won't say the C word with COVID. Anyways, that environment does add in a couple of extra layers in certain scenarios. And so we can talk about that as well. Just to get right off to it with the credit scoring, I know that both Van Dyke and Cross Country have done a very good job at not, how can I word this correctly, Jake, help me if I am, but not raising the qualifications due to certain circumstances with COVID. We are maintaining what they were previous. There are a couple of layers, again, a couple extra special things in there, but as far as specifically relates to the credit score, for example, for what we would call a government loan, if it was a VA for active military, retired, veteran, those qualifying scores start at a 580. Do you guys share the same? Yeah. So we're going to be the same across the board for that. And also with FHA loans, which is a different type of government loan that is open to folks that are not veterans, and it is geared towards first-time home buyers. The credit qualification score for that type of loan starts again at 580. So I would write that down, leave it in the back of your mind, because I do get calls at least a couple times a month, and some potential buyer has been told by either another bank or maybe another agent outside this office that the credit qualifications have moved up, right? It went from 580, now they're 620, or now they're 640. Be that as it may, that is not what you're going to have here in this office with us. So I think that's an important thing to make note of.
Question for you.
Okay.
What is your definition of a first-time home buyer? I mean,
That's
a great question.
Because there's a lot of misconceptions around that term also.
You haven't owned a home in 3 years.
Right.
Okay.
There it is. So the magic number is 3 years. In other words, if you were to purchase a home, sell that, after a 3-year period of which that home has been sold, you are now, in our system, right, in our eyes, another first-time home buyer. So you can take advantage of those credits and programs and special circumstances to help you get your home.
Now, when we're talking about minimum credit being the 580, that's what the agency standards are.
That's right.
With the COVID, we're still taking them into consideration, but we both are working off DU and desktop underwriters. Credit has become more important than it ever really has recently.
Yeah.
So while 580 is still the minimum because that is the government standards, we're still, I mean, credit affects your rate. If you're going conventional, it's gonna affect your MI rate. So it's just becoming more and more of a thing, and we're really finding that it's like a game with money, really, but the amount of people that are not up to date on what credit is and how to play the game is pretty wide. So, a lot of people are using Credit Karma to monitor their credit, and it is a good tool. However, there are different scoring models when it comes to credit. The one that we're looking at for mortgages generally is off at about, I'd say about 20 points from what we're seeing on Credit Karma.
It's pretty.
So people are thinking that they have, you know,
600.
above a 700 credit score, and we're pulling it, and in actuality it's a little bit lower. So it's a good tool in order to build credit and to keep on top of it, and to keep, and you know, identity theft is a thing. So that's
more of
also
a monitoring system.
It's not gonna.
And it is really a true representation of what your credit score would be, you know, in a mortgage bank.
Now, a useful tip would be, if you don't, a lot of people are saying they don't want us to pull their credit because it's going to affect their credit score as it is. That's a misconception generally. We can pull your credit. Where you're going to take a hit on your credit score is if we pull your credit because you're shopping for a mortgage, and then you went and look at cars, and then you went and opened a credit card. So multiple inquiries from different places is going to what's really affect your credit.
So multiple inquiries within one service industry is fine, but if you
They're
start
expecting
going
you to
out-
shop mortgages.
And that's a great point, Debbie. I'm glad you brought that up, because I wanted to mention that, as Jake was saying, if you were, a client comes to us, has their credit pulled, in general terms, Jake, what do you see, a 2, maybe a 3 point? Not
Nothing.
even.
Not that's gonna make a difference.
It does list an inquiry, again, we have to be upfront in that, very honest, it is going to list an inquiry on their credit. And the credit bureaus are assuming that there's a high likelihood that this consumer is gonna shop. So they may come to cross country, they may go to Van Dyke, and they may go to the next mortgage bank down the street, or maybe a Bank of America type thing.
Navy Federal.
There you go. We know you love your Navy Federal. And so, as long as that is done within a reasonable amount of time, right? Not one every 3 months.
They're not spacing out 60 days.
That's correct.
No, but
Then they
within a few weeks.
That's right,
Yeah.
exactly, Paul,
They're
within a few
expecting
weeks.
that.
They know that you're out there shopping for credit, and they're not going to continually lower your score for those inquiries. Now, that being said, when you pull up your Credit Karma, there's a high likelihood that they're going to account for that. So help coach some of your clients, or for you guys that are interested in potentially buying in the future, just keep that thought in the back of your mind. So it won't hurt.
And then another useful tip that we have, if you're working with somebody, or if you yourself want to see what score we would see as far as your mortgage score, because it's a different scoring model, you can go to myfico.com. Now, it's not free, but on the right-hand side, if you sign up, and it's a subscription, so you can pay the one-time subscription and then cancel it, and then you can see what's called My Mortgage Score, and that will be the exact mortgage score that we're seeing. So if there's questions about it, if they want to be certain before they do it, I always recommend it doesn't cost you anything to let us pull it. We can coach you on it. And we're not credit counselors, but we know a couple of tricks that sometimes help. And if we don't, we can push you in the right direction as far as who to talk to from there. But common misconceptions is, they've been changing the scoring models a little bit. So keeping balances on revolving lines of credit, meaning credit cards, the golden rule is about 20%. If you really want to see an improvement, they're telling you now to pay it down to 3. So,
And just to put that in perspective, a $1,000 limit card, you would want to keep it to a $200 balance or less if that 20% rule applies.
and if you're looking for an improvement in the score, you want to
Much
pay it down
lower.
to much lower.
Yeah.
Like, pay it off.
Pay it off.
And I'm glad you said that, Paul, because oftentimes we will see some folks that have open lines of credit that are not being utilized. And sometimes when they're completely dormant for months or years on end, it's not really reporting any good credit history. It's not
Right.
bad, so that's okay. but it's not also showing
It
their
doesn't show
ability to repay.
To repay.
And
right.
so oftentimes, I'm sure Jake sees it often, I do, is that folks have pretty solid scores, they don't really utilize their credit, and maybe when we start this process, we give them that little tips and tricks. Hey, why don't you just put your next couple of tanks of gas on that card, you know, make your payment, pay it off next month, keep on top of your regular monthly payments as always. You'll actually see a score improvement because you're using your credit, and the credit bureaus can see, hey, this person's using it, they're paying it back, they're very responsible, low limits again, 20% or less.
So if you have some,
And you can see a nice increase.
so if you have people, and there are people like this, they'll use their credit card and then pay it off every month
That's what you.
over, you know,
Yeah,
years.
which
Have
is
a-
great if it's being
They
utilized.
have a record of
Yep,
using it. and paying.
They're your 800 credit score.
Exactly.
Right, yeah, okay.
And I mean, that's really I mean, you see revolving lines of credit where people are utilizing credit cards as if to get the benefits and paying them off.
Yeah,
right.
right.
That's a pretty common thing we're seeing really good.
Oh,
credit.
yeah,
So-
you'd be a fool in that too.
Yeah.
Like if you're collecting miles, you know,
Right.
airline miles or something.
Yeah, exactly.
So I mean, yeah, it's really, that's what I mean, it's really playing a money game. It's playing a money game, so, but a lot of people aren't versed on it, so we have to start getting that out there a little bit more.
Just based on what we've said so far, anybody have any questions, or did any of that, because sometimes we speak mortgage lingo, right?
Too
And
much.
that can come out too much, and we may use an acronym or a special
Drowning you.
term or something, and it's like, wait, whoa, was that English? So I just wanted to take a second, does anybody have any questions or not understand what we were kind of covering so far?
No, I had a question on the,
Sure.
on the credit. So if you have like a credit card that you kind of run up and you're paying it down, so it's like, you know, over the 3%.
Yeah.
But you have other cards that you have credit availability on.
Mhm.
Do they look at the total package of the 3% of the card?
Both.
Oh, okay.
Yeah.
So that one card could mess you up.
The heavier weight would be your total. So in other words, I'll just illustrate, if you have 4 cards and only one has that balance and those other 3 don't,
Yeah, you've been
then they're
paying
gonna
off
look,
that one.
yeah, they're gonna look at the other cards having open utilization, right? And that will be better.
Okay.
So but they do look at the one card, right? If
They're
it is
starting
high.
to weigh it a
Right,
little bit more.
it's a weighting system, that's exactly right, yeah.
So,
Sometimes things happen.
oh, totally.
That's what we call life.
Yeah, I know.
We've all been there, right?
There are a couple of things that are gonna show up on a credit report that, I mean, as far as first time home buyers, you're not gonna have, well, the 3-year first time home buyers may have this, but if if you're truly buying your first home, you're gonna see some things on credit like foreclosures, short sales, stuff like that. So there's different waiting periods for different loan products. Generally the lowest weights are, government loans, so, is it 3 years?
3 years.
3 years is generally where you're looking at.
That's
Yeah,
a
and
fair
specifically
picture.
what we're talking about is if there was a prior short sale, for example, where the bank bought the home for less than what, you know, the loan balance was, there is a 3-year period from which that home was sold back to the bank that buyer or borrower
And it's the deed
will
date.
need to, when it's recorded on public record, they need to wait 3 years before they'll re-qualify for another, specifically this would be an FHA loan. And so that's another common misconception, because obviously when we went through turmoil in 2008, there were a lot of foreclosures and there was a lot of, different stuff floating around, and some people thought that it was 7 years or 10 years or something like that. But it's a 3-year waiting period from a short sale to qualify for another FHA loan. So definitely important information, especially for agents.
Yes. And I mean, as far as credit goes, I think we pretty much covered the basics.
Yeah, I mean, and just to kind of summarize, I think everybody has a general idea, right? The higher the credit score, the better the interest rate. So like Jake said in the beginning, there's absolutely no cost and no obligation to come sit down with us, run the credit report. We will take the time and go over each item with you and try and help advise on how you can improve your situation. If it's something that's a little above our pay grade, so to speak, we both know people in the industry that do great jobs at credit improvements specifically. That's all they do. And so if that's what we need to do, we'd be happy to make that introduction, refer you to someone else that can better help you on what.
And at least give you a time frame.
Exactly. Yep.
Which
And we'll
you work.
continue to stay with you step by step until you qualify and there on out, so.
And if you don't have credit, you really do need to build credit because you will not
That's
be
right.
able to get finance.
Big
Yeah.
misconception
That's
is
right.
not having
So,
any debt is gonna.
Can you go into that in brief, or is that?
Building the credit?
Building credit.
Absolutely,
'cause
yeah,
that's
yeah.
where we are.
Yeah, so one thing that first comes to mind for me would be to open an account, right?
Okay.
And sometimes if you don't have enough credit history, they may not approve you for a standard credit card, but there is what is called a secured credit card.
Okay.
And so you can give the bank cash that is equal to your limit. For example, if you wanted a $500 limit, you would give the bank $500. They give you a credit card with a $500 limit. And so you utilize that, keep it under the 20% balance, and maybe some groceries, some gas, smaller purchases, and just pay it off regularly. And over, what would you say, Jake, a handful of months, 2, 3,
Three.
4, is when you can see a pretty measurable increase, especially if you were one of those folks that didn't really have a lot of credit history. You can build it pretty quick.
What I kind
That's
of
nice
always
with a secured card.
what I kind of always recommend is go to whoever you're banking with.
Yep.
And see what they're offering. A lot of times they'll give you, it might have a lower balance, it might not even be a secured card, but they'll give you like a lower balance credit card. But you
That's the
have to
best
use
starting
it
place.
responsibly,
Right.
so you have to know what you're getting into there. So use
Well,
it responsibly.
I
Keep
heard
it
that
down.
you should get a assortment of, like you should go and get a line of credit
Mhm.
at a bank, a credit card, that kind of thing, and then your utility bills
Yep.
also can.
Yeah,
So is
and
that about the three
That's
places?
that Experian boost.
Yeah, Experian offers a system that will look over your utility bill payments and
Oh,
add
will
that.
you have to ask for that?
It's through their system on either their website or their app. But yeah, Experian specifically is the one that has that.
Yeah,
They call it
it
Boost.
shows up. It shows up as a self-reporting utility charge, which that doesn't mean anything to you. What it means to us is we can exclude it. So it's basically they're taking what your average utility is and they're looking at it as like basically open line of credit to boost your score. It's just a way that they
That's
can.
what we're looking for,
That's
you
right.
know, boost your
Yep.
score.
Yeah, it's just another way to show the credit bureaus
Mhm.
that you have a good history of payments. Yeah.
Is there any other way you would suggest somebody to boost their score that has no score?
Time.
Time.
Time
Right,
and keeping
time.
it.
Somewhat of being patient. That it does take, like we said, I would think a minimum of 2 to 3 months if you're doing
Okay.
it.
Not years.
No.
No.
Okay.
Just a
Cause
handful.
I was told years.
No.
No, okay. Well,
I mean,
we're a year in, so we're good.
when
There
you
you
start
go.
when you start
That's
to get
exciting.
years, it's gonna start because another criteria that credit bureaus look at is average age of your credit score, or average age of your lines of credit. So if they're newer, they're viewed a little bit riskier. So seasoning, letting those stay open, don't close accounts, really either.
Yeah.
So, I mean,
Revolving accounts.
it might take years if you had a bad credit history to fix like a
There are
foreclosure
things
or
that stay
short
on your credit
sale.
report for.
If there was what
Negative.
they would call a major type event or
Right.
derogatory event, like a foreclosure or so.
Right.
90 day late, stay
Yeah.
out a long time.
And then, but to build, like she's talking about, it could be done in, like you
Relatively
said,
quick.
three months, you could get a start, and then within a year, you would have a pretty solid if you kept it.
Oh, absolutely.
Okay.
Yeah, absolutely.
Multiple revolving credit accounts, if you're looking to do it quicker and if really using them the right way, would probably be the quickest way to do it.
So you would have more than one revolving.
I mean, that's the quickest way to do it. I don't know if that, I mean, like I said, it's on how you use them too.
Yeah,
So
yeah,
if we're
yeah,
using
yeah.
them, if we're not using, if we're, running balances up, that's not gonna help you.
No, no.
But we need to keeping open revolving lines of credit is good.
Yep.
So the score that they give you like on the Discover statement, is it fairly accurate?
It's one bureau, so there's 3 bureaus.
Okay.
They might give you 2, I don't know on Discover. But
I think the Discover is, do they call it a FICO on Discover, I think?
Yeah, I think
It is fairly accurate, and I would say more accurate than Credit Karma, not quite as accurate as what Jake described if you go to the My FICO score, and then specifically what the mortgage score looks like. That is, at least in our experience, probably the closest. Yeah.
So
The
there's-
FICO,
But
Discover
it's
FICO
fairly
is
accurate,
fairly
to give you an idea where
we
you
didn't
are.
do the
Absolutely.
basics
It's a
too.
perfect
So if you
starting
get
place.
800 there, you're okay.
Oh, yeah.
Okay.
Pretty much. We didn't even do the basics of that. There's 3 bureaus that we look at: Equifax, Experian, and TransUnion.
Yeah.
And the middle, so you get 3 scores, the middle score is the one that we're using for your decision.
So not the highest score, not the lowest score, but the one that sits in the
Right.
middle is how we qualify the loan. And that is the most heavily weighted item when considering what the interest rate's going to be. There are other items, of course, such as the down payment amount, we can get to that, loan amount, things like that, but credit score is the number one there.
For determining the interest rate, but is that going to also determine whether you get approved or not?
It can.
It can. The credit score does not determine, or correct me if I'm wrong, the amount of money you can qualify for.
Right.
That is
Only in
based on your
very
income projection.
specific
Brings us
type.
to our next.
Yeah,
Oh,
specific
which
type.
brings us to our next
Yeah.
pillar.
Yeah.
Wow.
So
Segue.
What a new, we're gonna do income.
Income. I think income is
Important.
obviously a.
It is very important.
It is.
Yeah,
It
income.
is. Yeah, yeah.
Okay.
Common misconception would be that you can buy a house with absolutely no income. Although,
Very 2007.
yeah, we won't get into the details, although there are still
Too
a
much.
couple of, non-traditional products that linger out there in the industry. We won't talk, that's not what we're here to talk about today. However, income is another one of those items that has a lot of misconceptions. And some folks think that it is a very linear or binary type thing, like, hey, how many dollars do I need to qualify for X dollar price tag of a house? It's not quite that simple. However, when Jake and I can sit down with you and go through the pre-approval process, we look at your credit report, and on that credit report, it very specifically states what your obligations are. For example, the minimum monthly payment on your credit card is what we look at, and a common misconception is that we look at the balance. It's not that we ignore the balance. However, when we compute what's called your debt to income ratio, which is what allows you to determine your buying power and whether you'll qualify for the loan, like you asked Debbie,
And if you hear us say DTI, that's what we're referring
Yeah.
to, because we're probably gonna
debt
say
to
that.
income ratio. And so, at any rate, we would add up what your minimum monthly payments are for any auto loan, student loan, credit card, generally speaking, anything that actually reports to your credit report. And so that would exclude things like cell phone bills, water bills, power bills. Those don't report to your credit, so that's not going to be a part of the debt to income calculation. So anyways, with income being the topic, there obviously are many different types of income, right? We have people that are self-employed, they own their own business. We have folks that work for an employer, they receive a W-2 every year. And then we also, of course, have
Salary, hourly.
correct, breaking down within that W-2, hourly, commission, bonus, different things like that. And so there are some intricacies on what type of those incomes is being specific, the commissions and bonuses that we can use. That being,
time frame.
yeah, and that being said too, there are of course other income streams such as Social Security, disability, child support, and alimony. And so lots of folks think that, well, maybe because I'm, receiving a Social Security check, that's just not what the mortgage company's looking for. Well, they are. That's absolutely it. And we've approved many, many loans solely based on the Social Security
Yeah,
income.
any sort of fixed income.
That's right.
So any type of reportable income that
Yeah,
you
documented.
documented
Document.
is the key
word.
word.
Well, that
Verifiable.
And as far as W-2 income or anything, yeah, and it's job history as
Yeah.
far as income goes, we're looking at 2 years.
Mhm.
So you get your, like in my case, Social Security every month,
It's qualifiable
and
income.
that's qualifiable. And
Use it.
just like your W-2, or in our case, 1099.
Can I ask, because we do have such a population of hospitality and service industry people who get paid, an hourly wage, but most of their income is tips. How do they go about? Because obviously on their W-2s or on their
Tax return.
tax returns, they're only reflecting their income that they have to report, because why would,
10%.
yeah. Yeah, and then you have, let's say, $500 a week coming in cash, you have to show that coming in for it to be counted. If you do, what's the best way to have that be documented? Because I know when chunks of cash show up in your account, you've got to,
Claiming more.
so you've got to claim it on your taxes. Is that what you have to do? Have to show it on your taxes, but you also, like, when people gift you money,
Yeah.
you,
Okay, so yeah.
or,
We'll get into gifts and stuff.
Okay.
And,
so yeah,
with
it's the whole,
assets, but.
I
yeah,
had a
so
lot
we
of
can get into
hospitality workers, a lot of waitresses and people like that, wanting to buy houses because they're
Sourcing
making.
funds is
Yes,
what we're talking
thank you.
about.
Okay, I knew there was a good word there.
We'll get into that with assets, but
Okay, that's assets.
as
right.
far as you qualifying income, you're gonna want to, even with self-employed, if you have a lot of write-offs,
Mhm.
it's not
It's not good if you're
necessarily
trying,
great.
if you're trying to buy a house, right?
Right.
So you gotta plan ahead.
Yes.
And just to kind of answer what you were asking there, Debbie, is that, yes, is the short answer.
Yes.
It is possible to get those folks that are in the service industry that are receiving tip income and cash payments weekly and things like that from their employer, it is absolutely possible to get them qualified.
Okay.
It does take a little bit more work, right? There is some paperwork involved that has to come from the employer, which they're going to, in written verification, say exactly what their tip income has been.
Mhm.
And again, like Jake said, we look for a 2-year history, and so we have
Okay.
the ability to go back in time and make sure that there's a consistent level of tip income coming to show that there's a high likelihood of that to continue. And those are two important things when we look at income, is that there's one, a history, and two, a high likelihood that it's going to continue, because let's face it.
And tips to us are
it's a 30-year
synonymous
loan
with
most of the
commission.
time. Yes,
Right.
right.
Okay, so
So-
tips
Yeah,
equal
commission's the same
commission.
way.
Commission's the same way.
Right.
Bonus.
Bonus.
Yeah,
You need to show
exactly,
a
you've gotta
2-year
show a
history.
history there to show that you've been collecting it in the past.
Now, bonus and commission can be a little bit, these are kind of like weird little loopholes, but let's say somebody's only been getting commission for a year, but we need to show a 2-year history. If we need to get as much income as we can out of it, you can take that 1 year of commission earnings if they've been in the same position and
Divide it.
divide it over 24 months.
Okay,
So that we can use that as usable income too, but you're not,
But it's a little bit
it's,
sketchy.
and
'Cause if you-
9
'cause
times
if
out
you
of
take
10,
that and
9 times
divide
out
it
of 10,
over
the
24
borrower
months,
is, yeah.
then the monthly is
Yeah, it divides it
smaller.
down smaller, that's
Mhm.
right, yep.
And 9
Okay.
times out of 10, the borrower or buyer is going to be like, well, I know, and we know you make more money than that right now. But
Mhm.
what's usable is different than what you're actually making currently.
Yeah.
gotcha.
And in those specific scenarios, we'd love to get with any one of you guys on one-on-one after the meeting
Yeah.
too, and drill down, especially the agents in the room too, and kind of drill down on some of that stuff, so that when you talk to some of these potential buyers, you've got a good knowledge base there in your toolkit to kind of help steer them and educate them, so.
Okay. Thank you.
Did you guys have any questions about the income stuff that we were talking about?
No, I think you're okay.
Okay.
Paul, you said that there were several sources of income, I think, for her, right? There's
Yeah.
disability, social
Well,
security,
yeah, she has basically,
and her job.
yeah, she has a job and social
Perfect.
security,
Mm,
and then she has savings.
Great.
Okay.
So that's gonna help tremendously.
Absolutely.
Because the income portion also, you wanna have enough savings to show, that, is that part of the debt to income ratio? No.
That's
That's
more
gonna
of the
more
assets.
assets.
The assets, alright, so that leads into the third pillar.
But we
Yay!
She's been
we
around.
talked about a couple of things. There's some more misconceptions of income. Nurses are a good example.
Hmm.
They don't have a 2-year history, but they come out of nursing school making pretty good money.
Oh, okay.
We can, if they were in school you can use school as part of the 2-year history.
Oh, I didn't know that.
So, but we can only use their base pay for this, so if it's somebody just coming out of college and they get a job, we
Mhm.
can still use that and show that they were in school, use that as part of the 2-year history.
And there are several programs aren't there for like first responders, nurses, doctors, or that type of thing? In
And
that?
there was more so pre,
Okay,
but yes,
okay.
there are. A lot of those are too private.
It just goes off at a different.
Shop fees, right? Because they were ours, is what we were talking about.
Okay.
It's a T, it's
Okay,
Yeah.
no, we won't go
I
down
don't
that
know if you
path.
want.
But
No.
But the important thing to remember is, someone that had just spent a long time going through school,
Mhm.
or on the job training, And when they get their job and their career and they begin, oftentimes they think or may be told the wrong information that they now need to work for 2 years before they can qualify, which they go to school and they get a job within that industry in which they were trained and educated, then we are, absolutely, they're willing and able to help them qualify for a loan. The only real caveat being is if they were to open their own business privately as self-employed, then that is one area we would have to show a 2-year history of their tax returns being filed as self-employed. But if they get a job and they're an employer, right, and they receive a paycheck with taxes taken out is the simple term, then they will absolutely be able to qualify based on that, because we will show their 2-year history being part of their training in school. So that's
Internships are
absolutely
the same way.
exactly.
Really? Okay.
Yeah. Residencies for nurses and doctors, things like that.
Nice.
Yeah.
Okay, I did not know.
So assets.
Assets,
My-
tell us about your
my
assets.
Money in the bank.
Yeah, you have to have
Money
a
in the
bank. If we, step one would be that you have a checking account and both, ideally you have both a checking and a savings account, but we need to show paper trail, so put your money in a bank.
There you go.
I would say that, Jake, tell me if you agree or not, the biggest misconception with assets, in other words, bank account money that you need in order to purchase this house, a lot of folks think that you have to have a minimum of 20%
20%.
for a down payment, which in most cases is a really big number, right? That is just not the truth.
We
It is
can
not.
go, we have down payment assistance programs, we both offer those through Florida Housing, I think you guys do the same one.
Yep.
All through Florida Housing, their guidelines changed, but they've been pretty much the same pretty recently, but it's $7,500, when you get $7,500 through Florida Housing. They set their own rate, and they have their own kind of guidelines as far as minimum goes, but they're looking at $640 still, so.
Yep.
As far as credit goes, but it's $7,500. It is basically given to you until you sell the house or you refinance the house, and that $7,500 is due back. There was a time when it was fully forgivable over 5 years, and that's changed,
Okay.
and it was $15,000. So
Yeah, I remember that.
When
there
it-
was a time.
When it was 15,000,
Right.
so is it forgivable after the 5 years? Like it comes off like?
No,
Not anymore.
not anymore.
It's there for the life.
No, I mean, but if you had
If
already
you did
done
the
the program
15.
when it was at the 15. Mhm.
Yeah, it's the tiered system. So if you sold or refinanced within 1 year, I think $3,000 drops off every year that you have in the house.
Making sure.
Yep. But that's really that. I mean, as far as what we're asking for upon pre-qualification and to close your loan would be 2 months of bank statements. So when we're looking at deposits coming in, we will have to source large deposits. So this talks about, we've talked about gifts and how to do that. What qualifies as a gift, large sums of cash deposit, stuff like this. Like we're gonna ask for, documentation if it goes into 50% of their month, or 50% of their income.
Yeah, they're gross monthly. And
Gross
so,
monthly.
And so again, just like Jake said, the qualification, for loan approval would be to provide 2 months of bank statements. And so the underwriters will look through those bank statements briefly to see if there are any large deposits, and if there are, we need to source those. And so for example, if you've got a wonderful grandmother that's just so proud and wants to help you buy your first house, and she writes you this big nice check, and you go put that in your bank, and we say, oh my gosh,
Tell grandma
that's what
to
we
hold
call a
her
large
horses.
deposit. Where did this come from? You say, oh, well, my grandmother was helping me out. We say, okay, great. And what we do is we walk them through the gift process. So there's a simple letter that both parties will sign, specifically saying that money is a gift and not expected to be repaid, right? Because it does need to be a gift. And grandma can show that, hey, here's my bank statement to show that money came from me to, my grandchild for this purchase of the home. Fairly simple. We do it all the time, and it's extremely advantageous when that grandma exists in that person's life, of course. Right? And on that note, it is important to know for gifts that family is really the biggest, I guess, was preferred is lack of a better term, right?
Mm-hmm.
So in other words, if your neighbor gives you some money,
Be your cousin.
that's not the same as family. there has to be a tie there. So that's kind of somewhat of a misconception, that anybody can give you money,
What
right?
is your fairy godmother?
Not necessarily, well,
Yeah.
sure,
Your
yeah,
godmother,
family, right?
Yeah, why not? If
your cousin,
Yeah,
That's okay though,
fifth
cousins?
removed.
there's
I mean, no, really, if you are extended family, I mean, that's
yes,
Yeah.
does not have
fine.
to be immediate, does not have
Okay.
to be within your household,
Okay.
it's just a family member.
Just
I
some-
mean, well, and you, I'm sure.
And there are
you-
other sources, of course.
We do the same thing. As far as gifts go, if they haven't gotten a gift yet, there are easier ways that require to me, to us,
Yeah.
I'm sure less documentation is more. If it's a conventional loan,
Mhm.
and the funds never go to our buyer, they never pass through our buyer's hands, and they go, let's say we have the donor wire directly to title.
Mhm.
All we require at that point
That's
is a
easy.
gift letter.
Okay, so
We
that's
don't
easy.
require bank statements. Now, let me tell you, donors generally hate giving bank statements.
Yeah.
Not always, but that's just,
Yeah, they
they're
feel the
like, why do I
vibration.
need to
Yeah.
show that? It's
Sure.
clearly in my
Right.
account.
Right.
And we understand, however,
That's
we
the
still
rules.
have to show it.
So it's beneficial to, like you said, tell grandma or whoever, hold on, instead of giving it directly to me, as much as I'd love to see it in my bank account.
That's exactly.
Wait, give it directly to title.
Yeah,
Wire it into
Wire it,
title.
secure, it's,
and we'll help them navigate that.
and
So
then
much
on,
easier.
all you need is that one gift letter,
That's right.
and it makes everything just, you don't have to provide confidential
This
information
isn't, no,
or
this
anything
isn't for
like that.
FHA or VA,
That's only conventional.
only
Okay.
conventional loans.
Does FHA still require all of
FHA
it?
is still gonna require a bank statement,
Yeah.
Okay,
but
but conventional it would,
conventional,
okay.
that's a good.
Yep.
And can we do, put a pin in it, can we come back and tell Paula and Deara about conventional versus FHA? Cause I don't think you're gonna be going VA, right, you're not veteran,
VA.
so just the difference between the two and the requirements, cause I just thought about that now, I'm going, oh wait, did we talk
didn't
about?
even talk about conventional, we went right into
Right into
FHA.
FHA,
Yeah.
okay.
So, I mean, that's really about it on assets,
Yeah, I mean, just to kind of summarize, the biggest one is you do not need 20% down. As a first-time home buyer and a conventional loan without, let's not talk about down payment assistance, we'll just talk about a standard. They do offer 3% as a down payment, and that's 3% of the purchase price of the home. So $100,000 home, $3,000 down payment comes from the buyer. Can be their own money or gift from an acceptable source such as a family member. Another thing to note is that the FHA down payment is 3.5%, so they're very close to each other. Conventional 3, FHA 3.5, 3.5.
Gifts, or, sorry, not gifts, seller credits can also be used, which we haven't really talked about.
Right, now,
That's part of assets.
Okay.
And so, in addition to a down payment, everybody's heard the term closing costs.
mhm,
And so closing costs in the state of Florida, there are buyer closing costs and seller closing costs, of course. And so as it relates to the buyer, it is acceptable from mortgage lenders across multiple different loan types. In other words, it's accepted on VA, FHA, and conventional. For the seller, this has to be negotiated, of course, upfront on the contract, but for
Which
the
in this
seller to
climate.
contribute towards the buyer's closing costs. So I'll give you a for instance. If the buyer had a more limited amount of funds on hand, but they had more than enough for their down payment, not enough for all of their closing costs, it's common for that buyer to make an offer to the seller which would obligate the seller to contribute towards their closing costs on the closing day. So in other words, the buyer in a perfect scenario, and Jake and I've done this so many times, can sometimes buy a house and come to the closing table with only their down payment. The seller gives them a credit to pay all their closing costs, and now they've managed to utilize that money to their advantage, keep more money in the bank, or not have to maybe get a gift from a
You
family.
know, there are
or
max
something like that.
constraints depending on the loan type.
Yeah, and we're happy to talk about each
Yeah.
type of loan, because there are some maximums. In other words, the seller can only go up to so much.
Right.
If they're putting
depending on
X
the
down,
type of
you can
loan.
only get this much.
And
seller
that's important
concessions.
details to know, but again, it's kind of like a case-by-case basis, because it does get pretty specific.
Yeah.
and Paula, just to let you know from the
But just
buyer's
know.
side, what they're talking about, we do use it all the time. However, When you are asking for a seller to give you a seller credit, you're usually upping the purchase price. You know, that's the trade-off. They're willing to say, yeah, that's fine, I'll let it come out at closing, but you gotta pay more. It is beneficial because then Deira or whoever's purchasing does not need to take money out or, you know, of their savings and whatever. I think this is right, guys, like usually the seller credit, let's say it's $2,000 from them, $2,000 in your pocket is great, your mortgage payment is only going up maybe $5, right? You know, so that's an easier hit to take than taking $2,000 out of your savings account, so that's
Yeah, it
just
can
an
be
FYI.
a huge
Leverage.
advantage.
Mhm.
Yeah, leverage,
Right.
Right.
Well, I've sold a few houses and
Oh, so you know, okay.
I've always gotten caught with that, cause they
Mhm.
usually in the negotiation of the price of the property.
Right.
You know, they wanna do it as, okay, I'll pay that money, but
But.
you pay.
You pay this.
That's usually what I
So you
end
do
up
it,
doing,
but.
yeah, I get the but, you pay the closing cost, you know,
Yeah,
and I'm like,
yeah.
oh, okay.
Okay, yep.
So when he says
Sometimes it can
usually
be
they raise
good
the
for
price,
both.
I go, no, that never worked that way.
Right.
It all depends, yeah.
Recently
And
it
then-
has,
Yeah.
just because
Yeah, I've heard recently it's a good time to sell.
Yeah.
Yeah.
just
I- I
because of the
don't think
market
that's what
we're
they said.
in, it's,
I've done it,
Yeah.
raise the price and ask for the credit.
Yep.
it-
I think I've always
it's an
sold
industry,
at the wrong
it's an
time.
industry.
Yeah.
We have to assume, which brings into our next one, property.
Property.
Before we go, Deira, did you have any specific
How you
questions
doing?
about assets or any of that?
Okay.
Okay, we're
She's
moving on.
probably swimming.
Okay. Gotcha. Okay, so property, Jake.
Property.
Yes.
So the fourth component would be the property. Now, the different loan types, conventional FHA, USDA, they're all gonna have a little bit different property standards as far as what's allowable and what's not. FHA and VA and USDA are all government loans, are a little bit more strict as far as property standards go.
Like the condition
Condition
of
of
the
the
property.
property.
Livability is a big term.
So like FHA, or conventional is not gonna care about peeling paint, FHA is
Wood
general-
rot. and that
wood
kind of
rot,
thing.
stuff like that. Same with VA. Condos, we're talking about condos, we tend to look, I mean, FHA is an option. There's we're doing spot approvals, which is where we do a case-by-case basis where you can approve a condo without the whole unit or the whole complex being approved through FHA. As far as that goes, I think there's about 12 full condo approvals.
It's
in
extremely
Pinellas
limited.
County.
Yeah.
Yeah, it's
Extremely
a
limited.
small market.
And in a general sense, just to throw a little bit of context to what we're getting at here, is condominium complexes are little communities in and of themselves, right? They have to manage their own budget for repairs and manage, you know, the occupancy levels and things like that. So for instance would be a condo association that had some unfortunate circumstances and let's say ran out of their HOA money. An underwriter would see those condo documents and that would be a potential problem. But think about it from you moving into that community. Well, you would want your community leaders to be able to, if for any reason there was a problem with the structure or a problem with, you know, the doorway or entryway or any of the main building components, you would want to make sure they had money to be able to pay for that, right? That's an
Right,
important
get
thing.
hit with a huge assessment.
And so,
You
right.
don't want that.
That's exactly it, and so when we look at condos, as we look at the property to approve the loan, that's one of the biggest things we look at is the budget for the HOA to make sure that they have cash reserves to be able to maintain their property and keep it, the biggest thing honestly is safety, right? And that's a part of the property appraiser's job, and what Jake was saying about FHA and VA being a little bit more strict. They're definitely more strict in terms of any safety deficiencies. I'll give you a for instance, I had recently on a little front porch had a loose railing, right? And you wouldn't notice it unless you put some weight on it. The appraiser saw that and made a note and said this, you know, this needs to be,
Stairs.
yeah, this needs to be fixed, right? And for obvious
Stairs.
reasons.
Yeah.
Safety
Yeah.
reasons.
Safety is
Safety
the,
reasons.
yeah, safety.
It
and-
used to be very crazy, like a crack in the sidewalk leading up to it
Right.
on VA.
They
would
have
be an
relaxed
issue.
a bit.
They've relaxed a little, a fair amount.
And if you've got any specific questions when you're looking at homes, whether it's from your agent or on the internet or any of those things, and you wanna ask us, hey, would this, be a concern, we're happy to look at those on an individual basis anytime. We've both got a lot of experience of, the good, the bad, and the ugly coming from the appraiser, and so we can, help, kind of advise you guys through that and
And
make
then-
it feel a lot easier.
As far as property goes, on pretty much every loan that we do, we're gonna have an appraisal done. Recently, there's been a thing called an appraisal waiver that's really been kind of popular. It's been happening a lot more, especially with COVID, which is, it's great. However, some people are buying and they still wanna get an appraisal done because you wanna know how much the house is actually worth and not just take, Fannie Mae's word for it. So it is, we always have to give you the option of whether you want an appraisal or not if we get the appraisal waiver. And people are still getting it. It does end up saving you money. I mean, that's the
They're more
one.
few and far between.
Yeah, I mean, you have to have, generally it requires a pretty good down payment in order for these to happen, but sometimes we get
Because
lucky.
then your financing contingency kicks in. If
Mhm.
it doesn't, well, that's with the appraisal. If you get the appraisal waiver, doesn't matter, you're just gonna be
Right.
financing whatever anyway,
Yeah,
okay?
correct.
And
Yeah.
you've lost your get out of real estate free card,
Right.
okay?
pretty much.
Okay,
That was a good thing. to
However,
bring
there
up.
is tie-ins. We're not gonna get on
no,
that.
then we can go on so many
Well,
tangents.
that's a
yeah.
good thing to bring up because the purpose of, we're talking about the property and the appraisal, which is the opinion of value of that property. It's important to know that the mortgage bank is only going to lend, right, a mortgage based on whichever value comes in lower, either the contract agreed purchase price or the appraised value. So in the unfortunate and rare circumstance that the appraised value is less than what you've signed the contract for, the mortgage bank is not interested in financing something above what the appraiser says it's worth, right?
Mhm.
And in most cases, buyers are probably not interested in paying more for a home
Out of pocket.
than what it's worth. And in those scenarios, most contracts are written, they have what's called an appraisal contingency. That means that this sale is going to be contingent on the fact that the appraiser agrees the home is worth equal to or greater than the contract price. And if
Right.
it's not, that's a protection for you guys as a buyer to be able to either renegotiate your sales price or say, no, thank you, I would like to back out of the contract and get my earnest money deposit back and go shop for another house that, I feel more comfortable buying, so.
Also,
So what happens, you guys are gonna be lending money on property and, okay, so the appraisal comes in low and then,
So there's recourse where you can challenge it.
well, you can,
Yes.
Can.
but,
Correct.
if the appraisal comes in low and the buyer says no, then, or they're not able to get, or they're not able to get their financing
Right.
as a result of the low appraisal, which they still get out of the contract
Yes,
and get their earnest money back,
yes,
but that's not always guaranteed.
Some would debate that.
Yeah,
with
But
the
if you
appraisal
put-
Part of
contingency.
the
but
financing
but if you,
contingency.
right,
If it's a government loan such as an FHA or a VA, those appraisal contingencies are required to be
yeah,
in
yeah,
the
and you
agreement.
have that,
If
right,
it's a conventional purchase, they're not required, so it's always suggested.
Right.
Of course, case by case, it's an agent's job to.
and then,
file
it is
the
if it's
case by-
conventional, the buyer
Mhm.
has the opportunity to say, it's okay,
Well-
I've got the extra money to
Absolutely.
make up the difference, I want the house.
Or they lower their down payment
Mhm.
and
Yeah.
make up for it that way.
In the, for instance, that let's say 20%, they're putting it down a larger deposit, or down payment, excuse me, the 20%. And hypothetically, if the appraisal came in a few or so $1,000 short, in that scenario, if the buyer doesn't want to contribute more cash to maintain their 20% and add on the shortness. So for example, if it came in $4,000 short, we would add $4,000 to that buyer's down payment to keep everything essentially the way
We'd
it was.
lower the down payment of the buyer for
That's correct, or you would
$4,000
lower it.
The buyer's still coming out of pocket, the $4,000,
That was
but they're
confusing when
putting
you
less
said that.
into it.
Oh, well, okay, I got you, so their down payment is
So, I mean, the
less.
perfect
Well,
example, even if
as
it's-
long as it doesn't dip below the 3.5% or
That's
so,
correct.
if they're doing that, then they don't have that.
Right, if they're a first time home buyer and they wanna put
Right.
5% down and then something
Yeah.
happens like this, a small discrepancy, we can lower it
Right.
ideally and do a 3% down conventional and be fine.
Yeah, but some people don't have that
But
luxury
yeah,
That's
either,
Right.
when,
Yeah.
that's when we're, yeah.
so then it's an issue.
Right.
Yeah.
But yeah, to answer, I know what you're getting at, I've had the answer both ways. Because we can't
Really,
technically win, if we can't technically
really,
win
the
on
only,
it,
yeah, so
it's a
really,
financing that
the
is-
only way to guarantee that the
Appraisal.
buyer can get out of it if he doesn't like the way the appraisal comes in, is with the appraisal contingency.
That's your
it.
that's your double check, right?
Right.
That's your
Right.
backup.
Yes, yeah,
Right.
So, I mean, as far as property, it's obviously a case by case basis, we do have options as far as, there are rehab loans out there.
Mhm.
You finance in repairs, improvements, generally repairs.
How much
So-
does that, I mean, like, so you're buying a $200,000 property that needs to be repaired, how much can you go up to?
20% of the
20% of the value,
Yeah,
yeah?
and
Okay.
it does, you know, and this will be something we can talk about further, with some of you guys, the agents, is that it will change from FHA or
Okay.
conventional and things like that. So there's some important stuff to note there. However, what Jake was saying is there are quite a few products out there to do repairs and renovations. If it has an older, outdated kitchen, right? There are loan options that when you purchase that home, it can include the renovations to do that kitchen. And they will, yeah, and they will, as the appraiser, they will appraise the property on the completed
Okay, and
renovated
that's how you
product.
get, okay.
Right, that's exactly it.
Yeah,
Okay.
and you're also gonna see appraisals come in with repairs required. I don't know if cross country
Yeah.
does this, I think everybody does
Yeah.
it, escrow holdbacks,
Yes, okay.
Yeah.
that is possible.
The roof,
Right.
Yeah.
Right.
Mm-hmm.
water heater,
Yep,
Right.
I had a broken
No.
window recently.
yeah, broken
You
window.
know, a little crack, nobody noticed, and that's the
Mhm.
safety issue, so the appraiser notated it. And the term that is in the industry is they say subject to.
Okay.
And what that means is they'll give a value to the home subject to these improvements, meaning if these improvements are done or safety concerns are addressed and
This-
repaired,
then
then
this
the
is-
value is this number.
Okay.
Without that, I'm sorry, we can't, allow this transaction to go forward. And again, it's mainly safety concerns
Yeah.
like deficiencies or broken items or something like that.
Roof life.
Right, roof life is a big
Active
one.
leak.
Okay.
Yeah, actively.
You do that on condos as well? I know that they're looking more like condos and villas and stuff like that. Is that, you do repair? Okay,
Yeah,
just
yeah, I
wasn't
mean,
quite
it
sure.
still exists.
Okay,
It's typically
More rare.
more from the inside walls,
Mhm.
right, and not so much of the
The
building.
outside.
Exterior.
Because
Right.
that's the responsibility of the HOA, however, it is taken into consideration.
okay,
And also, I mean, we're not part of this, but your home inspection is important.
yeah, very
Um,
important.
For more than one reason, one being your insurance. You're gonna get a 4-point inspection plus the wind mitigation, which is gonna help you with your
Insurance
rate.
premiums.
Right.
So that's part of a buyer's due diligence is to do that. It really has nothing to do with us. Don't send us
Yes.
the.
We never
home
send.
inspection.
Never send it to the lender. You always tell them
Underwriting
everything
advantage
is
mortgage,
beautiful.
Always a good thing to note that the home inspection, although similar, is very different than the appraisal. The appraisal is how much is it worth, the inspection is what
What's
kind
wrong?
of quality is this home in.
Okay,
If there's any deferred maintenance, that will be notated in the home inspection, and unless it's a major, deficiency or red flag, if you will, the appraiser only notates that. They're not going to notate the minor, stuff that the home inspector's gonna find.
Right.
So
And-
they work for you
Yeah.
more than they work for the bank. The appraiser more works for the bank in the sense of valuing the home.
And nothing to do with us. It's important that you, as a first-time home buyer, you're there and you get to see what you're getting into
right,
to make the best decision for you.
right.
So,
Yeah.
Something might not matter to you and
or
you're
you have
just
no
like,
idea what you're looking at, but
Right.
this person does it for a living,
Right.
so.
you know,
Good idea
oh,
to be there.
the tile's broken, that doesn't matter, I don't like the tile anyway, I'm gonna put something else in.
Sure.
Okay, great,
And that's
yeah.
important to know.
Right,
Yep.
right.
Do your dance. But,
Uh,
I
alright.
mean, as far as property goes, we have a whole list of property standards that, that's more agent focused as
Mhm.
far as what would be, what will fly FHA, what won't.
Right.
or, you know, fly government, and what will just have to go conventional, but.
Paul and Dare, do you know which way you would prefer to go? Would you prefer to do FHA, which is going to have the lower, very similar to conventional? I will say the one thing on FHA, you guys could probably explain it a little clearer than I can, is the PMI, the property, or the mortgage insurance.
So mortgage insurance, on anything, so on government loans, FHA, VA, USDA, and mortgage insurance throughout the life of the loan. That's a monthly fee that's just calculated into your full monthly payment, and that is what it is for the life of the loan there. For conventional, it's anything with a loan to value above 80%. So if you owe less, as soon as you owe less than 80% of your house, mortgage insurance drops out. A few ways to get out. I mean, one would be if you're buying a house, you put 20% down, you don't have MI. Eventually, through your amortization schedule, which is how much you're paying it down every your schedule of payments and where the loan to value is, it will eventually fall off.
Or you keep an eye on it, you can write, I was watching and I wrote mine, I'm like, it's time,
That's
I'm
how I
at
did.
80%.
But the amortization doesn't also factor in appreciation
Ah,
rates
market
that
okay.
we're
appreciation.
experiencing,
Didn't
which is
think
higher
that.
than
Right.
an
But-
average area.
So, I know, Paul, you probably know, so the difference between is that one, you can get rid of the mortgage insurance, and the others, you
Yeah,
can't,
you
it's
can't,
just
yeah.
built in.
Yeah, cause I was kind of, and I've never, cause I know my first house, I think I did go FHA, and then I've always gone conventional
Yeah.
since then, and I've never really, I think at the time, the reason we went FHA is because the down payment was lower.
Well, yeah,
If I remember right, that's the reason.
That's
it was
probably,
FHA.
yeah, years ago it was,
Yeah,
absolutely.
but now,
It's
it kinda
different.
sounds like it's a little more to
Yeah.
go FHA.
It's a little bit different,
So,
for
and the
sure.
fact that we're looking for condos and we want a Pacific area,
Yeah.
Right.
I'm thinking like, we should just forget about
FHA.
FHA altogether.
yeah, I
Yeah.
think,
Cause I don't really see the benefit in it, you know.
right,
I mean, as long as we have the down payment and the credit score, you know, is where we're
needs
good
to
with it, then there's not a problem with that.
yeah.
for sure.
Conventional though, definitely, as a buyer's agent, is definitely easier when we're dealing with condos, just because of like they talked about, it's not so much you, it's the condo association.
Which
And-
that's the part of condos that scare me.
Yeah.
But townhomes,
For her, I think it'd be good.
townhomes and villas, way different
Yeah, but
than
better,
condos.
Oh,
If
really?
it's zoned as a condo, that's the only time, but if it's zoned as a PUD, townhome, villa,
Yeah, we're
it's different.
so,
kinda look,
yeah,
well, I don't know, we're just like.
right, you're just
starting-
getting used to
Yeah,
it.
yeah. She
I
was
mean,
going
one
around
thing to
looking,
think
and I
of-
think she's liking a little villa idea
Nice.
better.
The villas are, cause you get a little backyard, you know,
Yeah, it's a little more homey.
a little bit, yeah.
Yeah.
Might have a
Like,
garage, you
we
know.
went and looked at one, she goes, I don't like that one. I go, well, what don't you like about it? She goes, yeah, it looks like a hotel.
Yeah. A lot of them do, so
Yeah,
you're
yeah.
right.
Actually, I was looking at a retirement
Mhm.
home, and, that's what I liked about it. This looks like a hotel.
I'm like going to stay at a resort.
You check in and-
Exactly. So no, but there are several ones that, you know, we'll look at it, but I just wanted to make
Yeah,
sure you
yeah.
knew so that, you
Okay.
know, when we're comparing and contrasting
Yeah, yeah,
things, you know where we're at.
Yeah, but that's what I was kinda getting out of them, it's just, you know, FHA would probably.
Yeah, it's a little confining at
So
this
the
point.
FHA might be, she might be able to qualify easier, is that the reason?
In
It
certain
depends.
circumstances, they do have a higher, or more lenient, I should say, qualifications. Specifically, one for FHA that differs from conventional is the debt to income ratio. And
Oh,
what
so
that
that
boils
should be-
down to is the FHA will approve a little bit more in terms of the loan amount and buying power than a conventional loan.
Allows your DTI to go up a little bit higher.
Yeah.
Mhm. Right, but that's not an issue, then
That's
you're
not a
okay.
That's gonna be an
So-
issue, that's gonna be.
Yeah, the only other would be, in the sense of in certain circumstances with a credit score that is lower, sometimes FHA will
Yeah, so
provide
that's- yeah.
a
So
better.
that's your thing, is the credit, is building up the
Well,
credit
yeah, you
for
know,
her?
Getting that up,
Mhm.
but, you know, we were told 680.
See, that's what we were just talking about, that's a
So,
common
you know,
misconception.
So important to know is that
Yeah,
the-
so you all come in and we're going, all right,
Yeah.
this afternoon, y'all ready to show us?
Ready to go
Well,
shopping.
Yeah.
I mean, something to be cognizant of is, the higher the credit,
Oh, yeah.
Obviously,
Yeah,
I mean, as far as
obviously,
rate goes and
yeah.
everything, but yeah, I mean, it shouldn't be
Yeah.
stopping you from doing if you want to do it now.
Yeah.
As far
Mhm.
as,
Especially if we could do, do a few little things that might bump it up
Yeah.
just a little bit.
Mhm.
yeah, and then we, like, knowledge is power, so that's kind of.
Yeah, that's why we're here.
Yeah.
Right, Dale? Knowledge is power.
Okay, so I don't think of anything, I mean, we had some questions just more for the hospitality industry, which we can ask you guys about in a bit, just like people who rent, how, what if you're renting, not from an apartment where you have actual leases and contracts and stuff like that, but the sketchy landlord who doesn't have any sort of documentation of you paying Demetrius,
The biggest piece of advice I would give anyone that is renting from an individual and not like from an apartment complex where everything is well documented is to write a check and very carefully in the memo, right? This is September's rent, this is, so on and so forth. And every month you write that in there and you keep copies of those checks yourself.
And we should be able to look at your bank statement and be able to show that.
Right.
Yeah.
And
it's
even
just
if you
the
don't,
more
If
documentation.
you're paying cash, it's
but that's the
like,
thing, is
That's
go
right.
get the cashier's check.
I mean, we
and-
use
or-
Venmo.
Or what is it,
Oh, yeah.
money order,
But it's, that's
and do it
documented.
that way,
It is,
because,
but don't pay
If
cash.
you, if you pay
Right.
cash, you're
yeah,
crap
that's,
out of luck.
It's impossible to document in that
Right.
sense, right?
Same
okay.
with gifts.
And then okay, can you, that will affect alright, this goes back to the credit thing. Every time you run my credit, right, it does not affect your score unless you wait like more than 3 or 6 months. Not run credit, numbers. Oh, Jake, Mike, can you see if I could buy a $250,000 house? Okay, well now I want a 275. Every time you run numbers, it's
We're
not
using the
dinging your
same
score.
credit report.
Right.
Yeah.
As
It's-
soon as we
it's
pull your
just
credit,
running
it's good
numbers.
for 120 days.
Okay, and when you run numbers, you don't rerun credit.
That's right.
Okay,
And we're both considered mortgage bankers, I think you guys are, but the difference would be a mortgage broker might run your credit multiple times
okay,
to go through, to shop it with
Different.
different.
Similar to if you've ever heard a story or experience going to one of those really big car lots, right? And they might have multiple financing lenders. CarMax is a great example, and they may let 5 or 6 different lenders run your credit report all at the same time. And that would be, as for instance, where we were talking earlier, of where those multiple inquiries can start to pile up and reduce your score. And
Okay.
so mortgage banks only run one credit report for all 3 bureaus. It's good for 120 days before we have to refresh and pull a new report.
okay,
And it has to close within that 120 days. So
Okay.
that's a fair amount of time. So if you're serious about looking and we pull your credit, I mean,
that's 4 months, yeah,
Yeah.
so, alright.
Yep.
And then our favorite credit question. Alright, I know I'm gonna be buying a house, and so I am gonna run out with my Wayfair credit card, buy all the furniture and shop and get ready for when I buy my new house. Now that's before I buy a house, and then after I'm gonna go buy a car. So tell me about the ramifications of all that.
I mean, we always tell people not to make big.
We've both got a nice do's and don'ts that we
Yes.
can pass out electronically afterwards and send to your email, which I think is super helpful.
Mhm.
And Debbie, what you just described is like the kiss of death, right? They go out there and they swipe every credit card they got in every room, survey, Ashley furniture, deliveries, and this and that, and then the next thing you know,
Bought a golf cart for my new community.
yeah, the next thing you know, all that stuff gets reported back to the mortgage bank, and yeah.
And now you no
sometimes-
longer.
It used to be a much,
Well,
okay, that
especially
must
when
be
you
a
say, I'm
times
gonna
it
give you
can-
$300,000.
That used to be a much
My credit's
bigger
great.
issue
Yeah.
when we were doing undisclosed debt monitoring,
Yeah.
but it's still an issue. Don't go.
Don't go
buy
crazy
huge
before,
purchases.
or definitely not after.
Yep.
Before it's gonna ruin your debt, your credit
loan.
score and your income ratio, and then after, you just revamped everything that you got qualified for.
Right.
Okay,
Wait to close.
yeah.
You can do
Go-
it the day, you can do it after you sign,
Right,
and
after you
fun.
sign papers, yeah.
Go and spend your money.
Go spend it, you can have it
Go
in
and
the
decide
cart,
what
You can buy anything
put it
you
in the
want
cart,
after.
and then
That's
click
right. We've
after.
got the keys,
Yeah.
the papers with ink.
If you can't open the house, don't buy anything to put in the house.
Yeah,
There you
You can't,
go.
so
There you
don't.
go.
Great rule
So
of thumb.
I tell people all the
Until
time,
we can read the
we're
letter.
not buying buy furniture
hold
for
your
your
breath.
new house, just
Mhm.
wait. After the close,
Yep.
you can do anything
Also-
you want.
That's right.
Furniture financing it's not easy, cause that is, just don't go
So
open
don't
any
go.
new credit cards.
So yeah, while you're like you said, when you're shopping
No
your
new
house,
debt.
nothing, just keep it the way it
No
is,
new debt.
status quo.
Yep,
Got
that's
it.
the best. Just
Yes.
pay your bills on time like you
Yep.
always do. Maintain that
Just
status
maintain your
quo.
normal
That's right.
purchasing. Like
Another thing that
like
we're-
if you have a credit card that you use during the month
Keep
and then pay
doing
it
it.
off, just
Yep.
keep doing it.
Yep.
You
Okay.
don't have
Course.
to change that.
Stay the course.
Watch
Another
what's
thing we get a
working.
lot of questions on is breaking, so we don't look at your terms of the lease or renting, whatever you're renting now, we don't necessarily look at that. So if
Okay.
you have to pay 2 months, I mean, we're expecting.
Well, if the buyer's renting, they probably, and this is a discussion I have with them is, if you are renting, you need to know what your.
Terms are.
What your terms are, how much notice do you have to give?
Right.
And if it's a case, you need to know, okay, I'm breaking the lease, I don't care, I found my perfect house. You know, does that mean you owe them $3,000 to break the lease, $5,000 to break the lease, whatever? You gotta know that.
Gotta
too.
know. And that, what you're just describing made me think of something that I wanted to make sure that everybody was aware of, because it is another common misconception in terms of, when is my first mortgage payment due? Right?
Oh,
That's a huge one, because folks need to know that their budget, right, for getting out of their lease of their apartment and paying for their new mortgage is going to be something that they can afford comfortably and be okay.
Right.
And so I'll just give a for instance. We're in the month of January. Hypothetically, if your closing was today, you'd come to the closing table, you would have sent your bank wire for your down payment, closing costs, etc. Throughout the rest of the month, we're not gonna ask for any more money.
Yay.
The cool thing is, a lot of people don't know, is you're going to skip the following month. So in February, no housing payment. So for example, if you've got a client that's getting out of their old lease and there's a little bit of an overlap between
They
that,
make up for it.
they can pre-plan knowing that whatever month that they close in, the following month is gonna have no mortgage payment, and it will be the month after that. So for example, closing in January, you skip February, and then March 1 is your very first mortgage payment that's due.
Right.
So for folks that are getting a check every week or every 2 weeks or once a month, and it's regular, it helps them be able to kind of, strategize for that budget,
Right.
make sure it all lines up.
You still are responsible for utilities during that time, and if you're in a condo for whatever the
For the
associated
HOA.
fee would be for
Yeah,
February.
but in terms
But
of
the
your actual
mortgage,
mortgage
yeah.
payment, it will be on the
Which
second
is
full
nice,
month.
yeah. Yay.
What, the back of my mind, I was thinking, there was something where you wanted to close after the 20th.
Depending on the time of the month, it can impact the daily interest because, just imagine that it is a prorated type situation in terms of your property taxes and things like that. And those go into computing your closing costs.
So
if you
it's
close-
closing cost.
Exactly.
Later in the.
Yep, yep.
Okay.
Yep. So
That
within the
seems-
first few days of the month or the last few days, it can sway those numbers just a little bit.
Your daily interest, if it closes at the end of the
Yeah.
month, you're gonna have 1 day of daily interest compared to 31.
No,
That's
okay.
exactly
Yeah,
it.
okay, so your closing cost.
Yep.
Yeah, for
And
sure.
that's all the questions I had, so I just wanna, say, I don't have anything that I'm waiting on, but you guys, whatever you wanna
Yeah,
say or
fire
ask
will.
questions, they're here for
Jake
you.
will answer them all.
No, yeah.
Try.
Mike's on cruise control.
Well, we had one, but I don't know if it's appropriate
No,
for,
of
it's
course.
a personal thing. Deanna has, received services from the state for, persons with developmental disabilities.
Mm-hmm.
And I know there's programs out there that are designed for them, for housing for them.
So
Do you know, or where do you research that, or, this seems like a
It's-
big dark secret.
It's not really a big dark secret, we both kind of did our research on this a little bit.
Okay,
But what we're really finding is a lot of public grants
yeah.
and funding that can help with down payments
Payments.
and stuff like that. Where you find them,
Most often state and county
State
are
and-
ran, and we're happy to offline mind send you some stuff privately to your
Okay,
email.
I would appreciate that.
Absolutely,
Okay.
yeah, absolutely, yeah,
I
for
sit
sure.
on a board, a governor's board
Oh,
for
cool.
disabled,
Yeah,
and so, you know, they throw out a
that'd be
bunch
great
of
to
stuff.
share that.
It's, you know,
I
that
mean,
kind of thing,
yeah, and
so,
then-
yeah, it would be really great, cause
Yeah.
one of my things is, you know,
It
I
doesn't seem
look at,
centralized.
you can't have government supporting you your
Right.
whole life, and so I think when you, you know, you have a plan for future.
Right.
And where you're more independent and self-supporting and
Yeah.
stuff like that, the better off everybody is, you
absolutely.
know?
Mhm.
And, so,
love the way you
you
said
know,
that.
and I've got, you don't know how many booklets I've read. But it's like for the whole country,
Yeah.
you know, we don't have it here, and it seems like you have to break it down to the county.
You
It's
probably do.
oftentimes-
It's
Yeah, into the
oftentimes
county, and this county.
sometimes state, or
Mhm.
sometimes city.
Yeah, yeah,
That's what I found
yeah, I
here.
was just on a webinar, and it was like all morning, and it was on the counties.
Right.
You know, breakdown,
Yeah.
you know,
It's not centralized. I mean, I found that in my research. There's
Right.
not one resource that you can go to find it, which makes it pretty
Very good.
difficult.
Yes, yeah.
And I think what you found out was it's not, like you said, it's gonna be private grants and loans that you would have to apply for individually,
Right.
but would
I
totally
figured that's
be
what it would be.
accepted by
Yeah,
almost
we'll
every
accept
lender,
it. We
right?
can accept fixed income and anything like that.
Mm.
It's just as far as like the, we
Applying
don't have
for
any
it.
specific loan programs that would do this. There are things that are like grants that can help you with the loan process that we will also accept, but
Okay.
Yeah.
But nothing that, yeah, cause like when she was mentioning about the down payment thing, that kind of, cause that's what my understanding was,
Mhm.
is that you pay it, and then after 5 years it was excused, and I thought, well,
Not anymore.
okay, we need to tap into that, well, now it's.
It's gone, now can you use that down payment